Most people think the heart of Wall Street sits in New York, on trading floors, inside skyscrapers, under the glow of giant screens. But some of the most powerful, most opaque, and most profitable structures in modern finance are not built there at all. They are parked thousands of miles away, on a small Caribbean island with a modest population, the Cayman Islands. And once you see what that island actually does for global capital, you start to realize something important. Interest rates are not the whole story. QE is not the whole story. Even the Fed is not the whole story. Because beneath the visible machinery of finance, there is another layer, a legal layer, a leverage layer, a credit layer, and that hidden layer is where a huge amount of modern money actually gets engineered. So today, we are going one level deeper, beyond rates, beyond central banks, beyond the usual macro headlines, to talk about the Cayman Islands, and why this tiny jurisdiction became one of the most important pressure chambers in the global financial system. If you still think finance is mainly about the price of money, then this episode may change the way you see the entire system. If you look at the world's major offshore fund domiciles, one thing jumps out immediately. A huge share of offshore hedge funds and investment funds are registered in one place, not New York, not London, not Singapore, but the Cayman Islands. That is the first clue. Because Cayman does not look like the center of global finance. It does not dominate the imagination the way Manhattan does. It does not project power the way Washington does. And yet, behind the scenes, it hosts an extraordinary concentration of funds, offshore entities, legal wrappers, and cross-border capital structures. By the end of 2024, the Cayman Islands had more than 30,000 regulated funds on the books. To put that in perspective, the assets managed through Cayman-registered structures exceed $7 trillion, which is larger than the entire GDP of Germany. That tells you immediately that this is not some side note in global finance. This is infrastructure. So why does global capital keep coming here? The lazy answer is tax. The real answer is much bigger. At the deepest level, civilization is always trying to do one thing: build order against disorder, build structure against chaos, build systems that reduce friction and make coordination easier. Finance is one of those systems, maybe the most ambitious one of all, because finance takes future expectations, future income, future growth, and turns them into usable present-day capital. In other words, finance is a machine for pulling tomorrow into today. But the more complicated regulation becomes onshore, the more legal systems pile on top of each other, the more tax regimes overlap, the more compliance layers get added, the more friction enters the machine. Capital still moves, but it moves with drag. And that is where Cayman enters the picture. Cayman became a low-friction zone for global capital, a place where legal structures can be built faster, where cross-border vehicles can be assembled more cleanly, and where the plumbing of finance faces less resistance. That is why this island matters. It is not just a location. It is a financial environment. Think of it this way. In the US or Europe, a financial structure can feel like reinforced concrete, heavy, rigid, expensive to modify. In Cayman, it feels more like modular engineering, more like legal Lego. Feeder funds, master funds, SPVs, offshore wrappers, investor-specific structures, all of it can be assembled with far more flexibility. And that flexibility is not cosmetic. It changes what kinds of trades become possible, how quickly they can scale, and how efficiently capital can move. Then there is the second core advantage: tax neutrality. Not tax magic, not a cartoon version of secret money, but tax neutrality. That means the fund itself is generally not hit by another layer of taxation as capital moves across jurisdictions. So instead of getting shaved down multiple times at the fund level, tax liability is pushed back toward the investor's home country. For global capital, that matters a lot. Because serious money does not just care about return, it cares about preserving structure, preserving portability, and preserving efficiency across borders. And that is exactly what Cayman offers. A lot of people hear the words Cayman Islands and immediately think hidden money, tax haven, secrecy. But that is too shallow to explain why the biggest institutions in the world keep using it. In professional finance, Cayman's real role is much more precise. It is an offshore legal platform, a neutral interface for global capital. And here is something that tells you everything. The EU and the OECD have placed Cayman on their gray lists multiple times. And multiple times, Cayman was removed. That pattern is not an accident. It tells you that the system needs what Cayman provides, even if it would prefer not to admit it. It is not important because it is exotic. It is important because it solves problems, 3 problems, in particular. First, legal neutrality. Cross-border investing sounds simple until real legal systems collide. US investors, Chinese assets, a European manager, multiple jurisdictions, multiple standards, multiple liabilities. Suddenly the asset is not the hard part, the legal framework is. So global finance evolved the workaround. Put the structure in a third jurisdiction, use a legal platform the market already understands, and let that platform serve as the common interface. That is one of Cayman's core functions. Second, tax neutrality. Again, not because tax disappears from the universe, but because taxation is not repeatedly layered on top of the fund itself as capital crosses borders. That reduces distortion, preserves efficiency, and makes international fund structures cleaner. Third, freedom of capital movement. Cayman does not impose the kind of capital restrictions, FX barriers, or broad cross-border frictions that large funds hate. And for institutional capital, that matters enormously, because the worst outcome for serious money is not earning a slightly lower return, the worst outcome is getting trapped. So when people ask why Cayman matters, the answer is not that it is shady. The answer is that it is useful. And in modern finance, usefulness at scale becomes power. Before we get into the mechanics, forget every financial term you have ever heard. I am going to use something from your kitchen to explain exactly how Wall Street uses Cayman to run its biggest trades. Now we get to the real heart of the story. What happens when Wall Street combines a low-friction offshore platform with leverage, arbitrage, and industrial-scale funding? This is where Cayman stops being a legal curiosity and becomes a money lab. Let's start simple. Imagine an apple costs $10 today, but a futures contract for that same apple, 3 months out, trades at 12. You can buy the apple now, sell the futures contract, lock in a spread, and as long as your financing cost stays below the gap, you make money. That is the basic logic. Now replace the apple with US Treasuries, or equity index futures, or other high-liquidity instruments, and replace a normal investor with a highly sophisticated fund that can borrow aggressively, hedge precisely, and scale quickly. Now the trade starts to matter. Because the real power is not in spotting the spread, the real power is in levering the spread. That is the game. A fund buys Treasury cash bonds, shorts Treasury futures, finances the bonds in repo, borrows against the collateral, buys more bonds, layers on more hedges, and keeps the machine running. On paper, the spread may look tiny. But once leverage enters, tiny can become meaningful, and meaningful can become enormous. This is one reason Cayman matters so much. Because in a low-friction offshore structure, a strategy that might be slower, tighter, or more constrained onshore can suddenly run at much larger scale. And once it scales, it changes the market around it. That is what so many people miss. These trades do not just live inside the system. At scale, they start to reshape the system. They can improve liquidity in calm periods, yes. They can tighten pricing, yes. They can make the machine look more efficient, yes. But they also create hidden fragility. Because the entire trade depends on funding, stable repo funding, manageable margin requirements, functioning liquidity, reliable collateral flows. And if any of those break, even briefly, the whole machine can turn violent. What looked like precision can suddenly become panic. Now let's look at the charts, because this is where the story gets much more concrete. The first chart is not just about one country going down and another going up, it is about the changing character of Treasury ownership. For years, the Treasury market was strongly associated with sovereign buyers, reserve managers, and long-horizon official demand, players who bought Treasuries for stability, reserves, and macro strategy. But over time, that picture started to shift. Traditional sovereign influence became less dominant, while Cayman-linked holdings became much more visible. That does not mean every Cayman-linked holding belongs to one simple category, and it does not mean country-level custody data tells us the full truth. It does not. But it does show us that the structure of demand is changing, and that matters. Because when the ownership map starts to change, the behavior of the market changes with it. Then we move to the second chart, and this is where the story sharpens. This chart tracks estimated net cumulative Treasury purchases by hedge funds since 2017, and what stands out is that a major share of recent Treasury demand appears to have come from hedge funds, especially those likely engaged in basis trading. That is a huge shift. Because it means a meaningful part of Treasury demand is no longer just long-term, balance sheet stable, buy-and-hold demand. It is leveraged, transactional, financing-dependent demand that exists because a spread exists, because repo is available, because collateral can be recycled, because the trade can still be funded. And once demand looks like that, the whole market starts to feel different. On the surface, it may still look deep, liquid, and stable, but underneath, it becomes more conditional. Federal Reserve research published in 2025 suggested that Cayman-domiciled hedge funds may have added roughly $1 trillion of Treasury exposure since 2022, reaching around $1.85 trillion by the end of 2024. To put that number in context, $1.85 trillion is larger than the entire French stock market. And this is held by funds registered on a small island. Even more striking, the same research suggested that official cross-border data may be undercounting these exposures by something close to $1.4 trillion. That is not a rounding error, that is a warning. It suggests the issue is not only that leverage has grown, the issue may also be that the dashboard itself is incomplete, and if the dashboard is incomplete, markets can look safer than they really are. This is why I say Treasuries are increasingly being used not just as safe assets, but as raw material for leveraged arbitrage. They still matter as collateral. They still matter as safe assets. But they are also becoming inputs in a much larger financial machine. And when safe assets become industrial inputs for leverage, the system changes. It may look stronger, but it can become more brittle. Like a skyscraper built on sand, beautiful in calm weather, dangerous when the ground starts to move. None of this is hypothetical. We have already seen what happens when the machine runs too hard and funding conditions tighten. In September 2019, the US repo market suddenly seized up, funding rates spiked, stress surged, and what looked like a highly efficient market suddenly looked fragile. That event was not caused by one single factor, it was a pileup. Reserve balances had fallen, tax payments hit, Treasury issuance added pressure, and the funding chain itself turned brittle. But the deeper lesson was clear. When a large part of the system depends on short-term funding, everybody is calm until they are not. And when the turn comes, it comes fast. People sell, they cut risk, they post margin, they raise cash, and once everyone does that at the same time, a market that looked smooth can stampede. Then came March 2020. That was the real shock. Because when even the US Treasury market, the core collateral market of the global system, starts to show signs of liquidity dysfunction, you are no longer talking about a small crack in the plumbing. You are looking at systemic vulnerability. That was the moment regulators could no longer treat high-leverage arbitrage as a harmless efficiency tool. Under stress, it could feed on the market itself. Federal Reserve research later pointed to another major concern. Official statistics may have been underestimating the true scale of Cayman-domiciled hedge fund Treasury exposure by close to $1.4 trillion. So the problem is not only leverage, it is leverage we may not even be measuring cleanly. That should get your attention. Because once funding gets expensive, or disappears, large leveraged positions do not unwind politely. They unwind all at once, and that is how the system flips, from smooth operation to forced liquidation, from elegant structure to blunt survival. The Fed had to step in with liquidity. Yes, that was a rescue. But at a deeper level, it was also an attempt to stretch time back out, after too much of the future had been pulled into the present. Because that is what leverage does, it monetizes tomorrow, now. And when tomorrow stops cooperating, the bill comes due immediately. For viewers in Europe, this is not distant, and it is not abstract. If New York and Cayman form part of the system's core reactor, Europe often sits closer to the outer ring, connected enough to benefit in calm periods, vulnerable enough to absorb pressure when stress hits. Why? Because the euro area has a common currency, but not a fully unified fiscal backstop, because not all European sovereign assets are treated equally, because liquidity inside Europe is real, but uneven. And for countries outside the eurozone, like Hungary, Poland, or the Czech Republic, the channel is even more direct. When dollar funding stress appears, emerging market currencies absorb the impact fast. That is exactly what happened to the Hungarian forint in 2022, when global deleveraging sent it to historic lows. That was not a Hungarian problem. That was a Cayman and Wall Street problem that arrived in Budapest. And because when dollar funding stress appears, Wall Street does what it always does, it pulls liquidity inward, protects the core, repairs the home balance sheet first. That is when Europe can feel the chill, through exchange rates, through bond spreads, through pension exposure, through the repricing of risk across markets that households thought were stable. So what does any of this mean for normal people? It means one very important thing: do not confuse complexity with superiority. That is one of the biggest financial mistakes ordinary people make, not that they move too slowly, but that they assume anything more abstract, more engineered, or farther away from real life must be smarter, more elite, and more profitable. Usually, that assumption is wrong. Because real resilience does not come from financial complexity, it comes from durable cash flow. That is the thing that deserves respect, not the speed of leverage, not the glamour of structured finance, not the illusion of sophistication. If you want real financial security, start with first principles. Do not try to out-leverage Wall Street. Do not tie your future to the most synthetic and funding-dependent layers of the system. Instead, focus on what is harder to dilute, harder to repackage, and harder to financialize away: your skills, your earning power, your productive tools, your liquidity buffer, and assets that remain connected to the real economy. For households in Europe especially, diversification matters, across currencies, across asset classes, across narratives. Because when stress arrives, liquidity is not just a technical word, it is your freedom of action. The goal is not to become more aggressive than the system. The goal is to become less breakable when the system becomes unstable. That is not being conservative. That is being prepared. The Cayman Islands are one of the strangest creations of modern finance: an engine of efficiency, a legal accelerator, a leverage platform, and potentially, a risk amplifier. They helped global capital move faster, structure itself more cleanly, and operate with less friction. But they also helped create a world where more and more of the financial system depends on precision structures that may not stay stable under stress. So here's the question: when sovereign buyers step back, and leveraged capital steps in, when US Treasuries increasingly function not just as safe assets, but as raw material for arbitrage, are we looking at a new phase of financial sophistication, or are we watching the final stage of a system that has already borrowed too much from the future? The next time you see Treasury yields spike suddenly, or your currency weaken overnight, you now know where to look. Let me know what you think in the comments, and I will see you in the next episode. If this gave you a clearer picture of how the system actually works, hit the like button, it helps more than you think. And if you want to keep going deeper, subscribe. There is a lot more to come.